Welcome to Debt Free in 30, where every week we take 30 minutes and talk to industry experts about debt, money, and personal finance. I'm Doug Hoyes. Normally, the last Debt Free in 30 show every month is a frequently asked questions show, but we found that we have so many questions that our listeners want answered that during the month of July, we're going to take the time to answer all of your most frequently asked questions. To help me do that, I've asked my Hoyes Michalos trustees to join me on the show, and today I'm joined by a first-time guest on the show, so let's get started. Who are you? Where do you work? And what do you do?
This is Mendlowitz. I'm the trustee for the North York and Scarborough offices of Hoyes Michalos. I got into this business in the 70s. First, I became a chartered accountant with a national accounting firm, realized I didn't want to do that for the rest of my life, and then moved off into their insolvency branch where we specialize in bankruptcies and receiverships. I've been doing this since the mid-'80s. Went off on my own to start my own practice in the early 2000s and hooked up with you guys several years ago to coordinate the Toronto area offices, specifically North York and Scarborough.
Excellent. Well, thanks for being with me today, Benny. So let's get right to it. When someone comes in to see you, they've got problems. What are the most common questions that people ask? What's sort of sticking in their mind right off the bat? If you had to pick sort of from that list of frequently asked questions, what's at the top of the list when someone comes to see you?
Well, the big things they ask is, what does it mean to go bankrupt? They also want to know, what does it cost to go bankrupt? Those are the pressing issues that they have on their mind when they walk in my door.
Okay, well, so let's start with that then. So what does it mean to go bankrupt?
Well, here we have an individual or a couple who've got this debt load. They can't manage to pay their bills. They've got credit card bills, they've got loan payments, they've got car payments. They can't manage it. They need some help, and I'm there to try to help them come up with a plan to pay those creditors back as best we can, and it may involve filing a bankruptcy. There are other options, and I try to explain to them how that process works. How do they get themselves out from underneath their debt load and still get on with their lives?
And we'll get into a bit more detail as we go through as to the actual specifics of that. But I think the other question that people are asking you is, okay, what does it cost? Because that's really the gist of it, right? I mean, okay, I got all these debts. If I could just pay them off on my own, I wouldn't be talking to you. Presumably, by going bankrupt, it will be a less costly alternative. So what does it cost to go bankrupt?
That's a great question. I get asked that all the time. Somebody walks in my door. I know nothing about them. So I start asking them some questions. What type of assets do you own? How much income do you make? All of those items factor into how much it's going to cost them, if any, to file a bankruptcy.
So it's different for everybody then?
Everybody's situation is different. I have to do my own analysis to help them understand what the cost will be.
Okay, now you kind of hit on a few different points there. So you said it's based on what their income is. So why does that matter?
Well, our federal government says if you file for bankruptcy, there are certain thresholds, amount of income you're allowed to take home on a monthly basis. And if you fall below those thresholds, basically it's basically trying to cover your basic cost of living. If you fall below those, there's nothing you have to pay to your creditors. The government doesn't expect you to kick anything into the pot. But if you earn over those thresholds, the government expects you to pay some of that income to your creditors as part of the bankruptcy process.
And we're not going to get into all the detailed math here, but you can go to our website at hoyes.com, that's HOYES.com, and do a search for the phrase surplus income, which is what you're talking about, and it explains in much more detail what you're referring to. So in simple terms, a single person could make around a couple of $1,000 a month. If you make more than that, you're paying a penalty, a surplus income penalty of half the amount you're over. But it's different for every size of family. It depends on whether you're married, have children, and so on. So we won't get into the details of that today, but we're answering the question, what does it cost to go bankrupt? So the first issue is it's based on your income. But then you also mentioned your assets. So explain to me what you're talking about there.
So a lot of people come in and everybody's got a different situation. The biggest question that people will ask if they have a large asset is about their home. If they have a family home and there is equity in the home, and what I mean by equity is if you take a look at the value of the home and you subtract from that what you owe against the mortgage, if there's equity in the home, think about this. You can't just walk away from your debts in a bankruptcy and keep all of this equity. The creditors will want to be paid. They don't want you to sell your house. They don't want to take your house from you. But if there's equity, they would like to be paid. And that factors into how much their creditors will be paid in a bankruptcy.
Now, I want to get back to this whole issue of cost, but you kind of touched back on the first question, which is, what does it mean to go bankrupt? And what you're really saying is, well, it's a trade.
It's a balancing process in our system whereby if you can't afford to pay your debts, there's a way to get out from underneath it. But there are certain duties that you have to perform. And one of those is to help your trustee realize on whatever assets you might have, and that realization might involve paying your creditors some of the equity in your home.
And so the trade is, when I go bankrupt, I lose my debts, but I also lose some of the assets that I have.
Correct.
That's really the trade-off. And so the decision for somebody who has a lot of debts is, well, okay, is the bankruptcy going to cost me more than what I owe? In which case it doesn't make any sense. I should pay them off on my own. But if my debts are so huge that there's no way I can pay them back, even with all the stuff that I own, then the bankruptcy starts to become a logical option. So we're talking about assets. So the first one you mentioned was equity in a home. So if I was to sell my home, would there be any money left over? If there is, that's something you lose in a bankruptcy. And for our listeners who are listening to this on the internet through our podcast version of this, we are talking about Ontario law here. The laws are different in different parts of Canada. So you want to refer to wherever you are. But in Ontario, equity in a house is something that you lose. What are the other kind of common assets that people would lose if they went bankrupt?
Well, pretty much everybody who walks in the door has got a car. And there are rules in Ontario that says you're allowed to keep a basic car. So if you're driving a 2005 Pontiac Sunfire, there's a pretty good chance that you're going to be able to keep that in a bankruptcy. But I have many situations where people come in with a more valuable car, and the government has certain rules that says, yes, you're allowed to keep a basic car, but if you're driving a 2014 Mercedes-Benz, which you shouldn't be in the first place, and don't have any debt against it, you may have to pay your creditors some of the value of that vehicle if you want to keep it.
So a car that's worth $5,000 or $6,000, I guess as we record this in 2015, the exact number is $5,650. That's the magic number. So if you have a car that's worth less than that amount, the trustee isn't going to take it. You can keep it. If it's worth more than that amount and there are no loans against it, then you lose the portion above that. So if you've got a car that's worth $1,000 more than that limit and you want to keep it, you kick in $1,000 during your bankruptcy, you get to keep it. What if there's a loan against it?
Well, if there's a loan against it, usually there's no equity in the vehicle. The way the banks and the finance companies work is that if you were to sell your car today, you probably wouldn't get much more than what the value of the vehicle is. And then we sit down and we look at the numbers, but pretty much if you've got a loan, pretty much the scenario you can look at it, if you've got a loan against the vehicle, as long as you keep making those payments, you'll keep your car. There's no extra cost to be paid to your creditors.
What if the lender says, no, you're bankrupt. I want the car back. I don't care if you're going to keep paying for it. I want the car back.
Well, fortunately, the bankruptcy rules allow you to keep your vehicle as long as you're current with your payments. So as long as you're not behind and you want to keep that car, the bank or the credit company cannot take it from you.
So really, in most cases in a bankruptcy, if you want to keep your car, you can. You're either going to pay something for it if it happens to be a valuable car with no loan against it, or you're going to have to keep paying the loan. Those are your two choices.
That's right.
So, okay, so what does it mean to go bankrupt? Well, you exchange your assets for your debt. In most cases, most people you meet with don't have much in the way of assets. That's why they're in this situation. Now, back to the cost then. So, number one, I've got to pay a portion of my income if I'm over the limit. Number two, I potentially lose some of my assets. And we've talked about a house. We've talked about a car. What about my RRSP? Do I lose that?
Well, that's an important question. A lot of times people do have RRSPs. They have some way of saving outside of their pension at work. And as long as your RRSP has been in existence for more than 12 months and you haven't made any contributions in the last 12 months, that asset will be protected. Those rules were put into place a few years ago to prevent people loading up their RSPs on the eve of filing for bankruptcy and thinking that money or cash would be protected.
So anything you've put in the last year, you're going to lose. Anything else you get to keep even if you go bankrupt.
Correct. A lot of people will come into my office and they've changed jobs and they've got a locked-in retirement account, a LIRA. That's from a previous employer. It's been there for years. That's protected.
Gotcha. So in most cases, there are not very many assets you're going to lose in a bankruptcy. That's kind of what it comes down to. So the cost of bankruptcy, it depends on your income. It depends on what you own and some other factors. And what it means to go bankrupt is, well, you're exchanging your assets for your liabilities, which again, in most cases, isn't going to be a big number. So I think a lot of people also are going to come in and ask you, and you mentioned this to me before, well, what if I don't want to go bankrupt then? What are the other options? So what I want to do is take a quick break, and we will come back and talk about that. You are listening to a frequently asked questions episode right here on Debt Free in 30. We'll be right back.
What are the warning signs of debt problems? Where can I find a free online debt options calculator? Where can I get free ebooks and guides? Find all the answers at moneyproblems.ca, the website for Canadians with money problems who want money solutions. Moneyproblems.ca.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
We're back. I'm joined by Benny Mendlowitz, and we're answering frequently asked questions that he gets asked when people come in for his advice on their debt situation. And one of the questions you get asked all the time is, well, okay, what if I don't want to go bankrupt? Before the break, we talked about if you go bankrupt, there's a cost. If you have equity in your house, for example, that's potentially at risk. If you have a job that earns over the government minimum, then potentially you have to pay more. Those sound like negative things, but I've got a lot of debt. So what can I do if I don't want to go bankrupt, but I still want to be able to deal with my debt?
Well, that's a great question. So we've been talking about what does it cost to file a bankruptcy? And we've talked about if you've got assets like equity in your home, paying that to your creditors. If you make over the government's limit, having to pay some of that to your creditors because of these surplus income rules. Well, let me tell you about a story that happened last week. I met with an individual who fell into both of those categories. He had just gone through a separation divorce, and as a result, he managed to keep the home, but he had a good job. So not only was there equity in his home, there was also income that he would have had to pay to his creditors to file for bankruptcy. And it was a pretty expensive process. And on top of all that, he did not want to file for bankruptcy. He wanted to pay his creditors back something.
So give me a rough idea of what kind of numbers we're talking about. And obviously, we're not going to talk about this guy's specific situation because this is, we're not going to mention his name or anything. But when you say equity in his house, what kind of dollars were we talking about
If
there?
he sold his house and after paying his real estate agent all his fees associated with it, probably be something like $30,000 to $35,000 left.
Okay, so $30,000 worth of equity in his house. So if he was to go bankrupt, then you're either saying to him, give me your house or give me $30,000.
Correct.
Now, you also said he had income over and above the surplus income limits that we talked about in the first section. So what kind of dollars per month were we talking about there?
He was making about $3,000 a month take-home pay. So based on the numbers that we're looking at in our situation now, someone can take home about $2,000.
And we're talking about a single person.
Single person, because remember
he's divorced now, so he's got no spouse, no kids at the moment.
Kids. So he was over the threshold by $1,000, and our rules basically say you pay half of that to your creditors, which is about $500 a month. And he would have to do this for, as you know, 21 months. That's what the rules require you to pay surplus income to your creditors in a bankruptcy.
Right. A normal bankruptcy, if you don't have surplus income, don't have any other issues, if it's a first-time bankruptcy, you're bankrupt for 9 months. But if you're over the government's limit, then your bankruptcy gets extended for another year. That's where you're getting the 21 months from. So as I'm doing the math here, he's got $30,000 of equity in his house, and then he's got $500 a month for 21 months that he'd have to pay you, which is another $10,500 if I'm doing the math on my pad here correctly.
Right.
So now we're up into the $30,000 plus range is what a bankruptcy would cost him. And he would have to pay that money in 21 months. So he's going to have to either be giving you the house, or if he wants to keep the house, he's going to have to be giving you a lot more than $1,000 a month because he's only got 21 months to pay this $30,000 plus dollars. So what did you come up with then? What was the answer for this guy?
Well, we sat down and explained to him what his options were. And one of the hidden gems in the bankruptcy process is the ability to file a consumer proposal. So a consumer proposal is a process which is administered by a trustee, which we are, and it's a legal and binding settlement that you make with your creditors, whereby you offer your creditors more than what they would get in a bankruptcy, but it gives you a longer time period to repay that amount. You can pay a consumer proposal back over a maximum period of 5 years, 60 months. So we're looking at a 21-month payback to his creditors in a bankruptcy versus a 60-month period in a proposal. And as long as the proposal offers the creditors the same or more, it has to be more, can't be less, than what they would have gotten in a bankruptcy, it works out better for the debtor and the creditors. It's a win-win situation. The debtor has the ability to pay this because he probably can't come up with this equity in the home and make these surplus payments in under a 2-year period. But his cash flow will allow him to manage to pay these over a 5-year period.
And so what kind of numbers did you come up for this guy? What was his monthly payment that he ended up agreeing to?
We agreed to a figure of approximately $700 a month for a 60-month period. Works at about $42,000, I think. Between the equity in the home and the surplus that he would have had to pay, he's basically paying his creditors a little more than what he would have had to in a bankruptcy, but he couldn't afford to make those payments over a period of time based on his family situation.
And this was a guy who had significantly more than $40,000 worth of debts, I assume.
Oh, he was well over $100,000. I think it was $110,000 or $120,000 worth of debts. He had a significant amount of lines of credit and credit cards, which were all, which part of it became his responsibility as part of the separation. Part of it was part of his credit mismanagement. But however people get to my door, we try to come up with a solution for their problem.
And that's a fairly common situation where someone's gone through a separation or divorce that they end up with a bunch of debt?
It happens quite a bit. There's legal fees. There's a little bit of animosity. Sometimes one of the spouses agrees to take over the debts as part of the settlement, separation, or divorce, and they write up the paperwork, and all of a sudden one of the spouses is responsible for all this debt load that used to be carried by 2 incomes.
And I guess if you're splitting off and I've got to either start paying the mortgage all on my own now, or I've got to go out and buy new furniture, find a new place to live, get another car, whatever it is, those are all costs as well that add up. So
they don't go away.
They don't go away. So it's not unusual to see this situation. So the situation that this guy was in then was he had over $100,000 worth of debt, lines of credit, credit cards, the usual kind of things. And if he had paid it off on his own, obviously it would have cost a lot more than $110,000 because he would have to keep paying interest, for probably the rest of his life to pay that off. I mean, this is a guy who's making $3,000 a month now. So how long would it take to pay off $110,000 if you're also trying to pay all your living expenses? It's essentially impossible, I guess.
No, he'd be paying his interest every month, barely, if he could afford that. And at some point in time, he would run out of... It's a typical situation that I come across where somebody borrows from Peter to pay Paul. They're using certain lines of credit to pay this credit card and moving money around. He just couldn't manage it anymore. And he saw the writing on the wall. He knew he needed help. He came in and looked for advice from us.
And he could have sold his house, but that would have generated $30,000, which is not enough to pay off $110,000 worth of debt.
That's right. And then he would still have had to find a place to live. And a lot of times in Toronto, the cost of renting a spot is pretty expensive when you compare it to what your carrying costs are on a mortgage and your property taxes.
Yeah, because obviously he's living in a smaller house or condo or whatever it was that he had. And so if he had gone bankrupt, he would have ended up having to pay well over $1,000 a month during the bankruptcy. And that assumes his income didn't go up or change, in which case he could have had to pay even more.
Right.
But in the consumer proposal, $700 a month, it was an affordable number, still a stretch. I mean, it's not like he's getting off scot-free here, but it was reasonable for him. And then he's now in the driver's seat. If he wants to sell his house at some point in the future, he can. If he wants to keep living there, he can as well. But it's a reasonable payment. And so as a result, he did not have to go bankrupt.
He did not have to go bankrupt. We managed to come up with a plan that allowed him to repay his creditors a portion of the debt and avoid filing bankruptcy.
Now, obviously, you only met with this guy in the recent past. The creditors have not yet had a chance to say yes or no to this, but you've been in this situation, hundreds of times before. What's your expectation as to how the creditors are going to react to this?
I wouldn't be putting our name on the line. I wouldn't be sending this out to the creditors if I didn't think it was going to work. I know it's a fair deal because I'm a trustee. I'm licensed under the Bankruptcy Act, and my job is to make sure I'm presenting a fair deal to the creditors and trying to get the debtor out from underneath his debt load. So to answer your question, our experience is that over 95% of the proposals we send out the door work. 100% of the proposals don't work. I can't guarantee that because the creditors have a say in the matter. But those other 5% that don't work, probably can be negotiated upwards, because when a creditor says no to a proposal, there's only one reason they say no. They want more money. So we see if there's a little bit of room to compromise between what was offered and what they're expecting.
And in this case, if the creditors say no, he can still go bankrupt. He's offered them $42,000 in the proposal, $700 a month for 5 years. If he goes bankrupt, they're going to get maybe $40,000. So, or maybe less. It's dependent on his income. So from the creditor's point of view, it makes sense. They're getting more money. From the debtor's point of view, it makes sense because he can actually afford this. He gets to keep everything. And so it becomes a win-win situation.
That's right. There's usually some odd circumstances that may require an adjustment, or maybe you've got some unusual creditors like Revenue Canada, because they have different rules that they play by. But most of the time when we send these proposals out the door, they work.
Excellent. Well, that's a great way to end the segment. Thanks very much, Benny. We're talking about debt here on Debt Free in 30 and the ways to deal with it. We'll be right back. You're listening to Debt Free in 30.
Looking for information on budgeting, debt consolidation, credit counseling, debt management, and debt settlement? For unbiased advice, go to moneyproblems.ca, the website for Canadians with money problems who want money solutions. moneyproblems.ca.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
Welcome back. It's time for the 30-second recap of what we discussed today. On today's show, Benny Mendlowitz explained that there are costs to filing bankruptcy, but there is also a significant benefit, and that's the reduction in stress caused by excessive debt. That's the 30-second recap of what we discussed today. I think Benny hit the nail on the head when he said that many people he meets with are under a lot of stress caused by their debts. That's why he's happy to explain what bankruptcy is and what it costs, but he spends most of his time discussing how becoming debt-free can eliminate stress and give you a fresh start. That's an important message, so if you or someone you know has more debt than they can handle, there is help. Our website, Hoyes.com, that's Hoyes.com, has lots of resources explaining all of your debt management options, including the consumer proposal option that Benny illustrated on the show. The point is that there are options and there is help available. That's our show for today. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.
Thanks for listening. This was Debt Free in 30.
If debt problems are keeping you up at night, if collection calls leave you afraid to answer the phone, it's time to end the cycle. You can do something about your debt. Call Hoyes Michalos today at 310-PLAN.